75.7 million ounces of registered silver against 134.8 million ounces of open contracts. That is a 13% coverage ratio. That number does not stay stable for long. Silver prints 71.73. Gold holds 4,543. DXY sits at 98.60. Today is First Notice Day. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, weekend risk is building into Monday Open. Let's get straight into it. Before we go further, if this kind of data first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. COMEX May Silver First Notice Day. 134.8 million ounces of open interest from CME Group data. 75.7 million ounces registered supply from COMEX warehouse reports. Coverage ratio prints approximately 13%. Effective Thursday, April 30. This follows 6 consecutive months below 15% coverage. The unusual detail is persistence, not a one-week anomaly. 6 months. The timing is what deserves scrutiny, not the event itself. The timing. First Notice Day forces decision. Roll forward or stand for delivery. Think about what that sequence actually means. If even a small percentage stands for delivery, registered supply tightens immediately. If that tightening meets elevated demand, pricing adjusts fast. What happens if participation exceeds expectations? The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time coverage ratios compressed below 15% for multiple months, volatility followed. Not instantly, but inevitably. The data is already telling you something. Let's build it out. Now let's build the full picture because COMEX positioning does not exist in a vacuum. CME Group commitment data has dropped. 134.8 million ounces open interest across May contracts. That equals roughly 26,960 futures contracts at 5,000 ounces each. COMEX registered inventory sits at 75.7 million ounces. That is a multi-year low from CME warehouse reports. Year-over-year comparison shows inventory down from above 110 million ounces. That is a material decline. Now connect global demand. Shanghai Futures Exchange data shows elevated volumes. Shanghai physical premium prints 12.21%. That equals 8.77 above COMEX pricing. That premium persists for months, not days. That is not coincidence. That is a pattern. The rate of physical demand shift is not slowing. It is compounding. The data is doing the talking. The ones who have been called early for tracking physical markets, they are not saying much right now. And here is what makes that picture even harder to ignore. Global silver deficit prints 6 consecutive years according to the Silver Institute. Industrial demand continues rising from solar and electronic sectors. At the same time, paper supply through futures contracts expands. That creates divergence between physical and paper markets. That is not a contradiction. That is the setup. And before anyone takes that as a green light, delivery squeezes do not trigger on schedule. They build, they compress, then they release unpredictably. Setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not talking about. 21 million barrels per day through the Strait of Hormuz. That number drives global inflation expectations. Now Iran and oil markets, because this is no longer a backdrop. It is the primary variable. U.S. Energy Information Administration confirms 21 million barrels daily transit. Current geopolitical tension keeps that flow uncertain. Oil reacts immediately to disruption risk. Brent crude volatility reflects that uncertainty. Higher oil prices feed directly into inflation metrics. Inflation keeps central banks restrictive. Restrictive policy supports yields. Yields pressure metals short-term. Markets are still pricing contained escalation. Look at oil volatility and tell me what probability you assign to that. When markets price actual disruption risk, oil reprices higher, inflation reprices higher, yields move toward 4.60% or higher. That pressures gold and silver initially, but then real yields stabilize as growth slows. That is the historical pattern. Every time oil shocks feed inflation, metals reprice higher after the initial reaction. It has not been different yet. Now silver Western spot at 71.73, Shanghai equivalent pricing near $80 when adjusted for premium. That reflects an 877 spread. Gold Western spot at 4,543, Shanghai gold near 4,569. That creates a 24.78 premium. Short-term picture is unstable into the weekend. First notice day adds delivery uncertainty. Geopolitical risk adds headline risk. If delivery demand exceeds expectations, silver moves toward $78 quickly. If geopolitical easing occurs, both metals gap higher Monday. If yields spike toward 4.60%, silver tests $68 to $69. If DXY breaks below 98, gold targets $4,800. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. Current environment combines delivery mechanics and macro uncertainty. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that costs you. So let's run both. The bear case is real. 10-year Treasury yield at 4.42% raises opportunity cost. Federal Reserve signals no cuts through 2026. Oil-driven inflation delays easing cycles globally. The bull case is equally real. 13% coverage ratio shows tight COMEX supply. Shanghai premium at 12.21% reflects strong physical demand. DXY at 98.60 signals weak dollar support. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing. Structural pressure is building while timing remains uncertain. The squeeze condition exists. The trigger does not announce itself. Sit with that. Do not take my word for it. Verify every number I gave you today. Check the data yourself. CME Group, U.S. Energy Information Administration, Shanghai Futures Exchange. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.